Well, for those of you who know me a little bit better, well, you probably know 3 things about me. Boy, he talks. He talks a lot. Number 2, about half of my life, I was told that I have a weird sense of humor. The second part, I don't know. I have not lived it yet, so we'll see. And the third thing you learn about me is my sexy Ukrainian accent, right? So if you're up for lessons, I give them very affordable. Sign up. Girlfriend's going to help you. All right, my name is Shulik. Andrey Shulik. Anyone likes English spy movies? You got a point. Okay. So I'm here to talk to you about a little bit about the risk management introduction. And this is really introduction. This is like a tip of the iceberg. We're not going to go deep on this. I'm here to convince you to use it in your everyday life. Right. So what is the risk management, and why we should care? Anyone risk managers here? Lift your hand if you are one. Every single one should have raised their hands. And this is why. We do this on an everyday basis in our everyday life. And I'll explain what I mean. So, do you pay your bills? John, you pay your bills? Yeah. Okay. You pay your bills for a reason, right? So your electricity doesn't get shut off, right? Do you decide where to go to vacation? That's a part of the risk management decision because it's an action that you have to do. You're actively thinking about where to put your money and what kind of investment and what you're going to get in return, right? Do you stop for traffic? That's another risk management practice that you do every day. A little bit of definition. So I'd like to take it a little bit to a more scientific approach to it. And today, the other 2 topics that I want to touch base is the risk management, the freight broker and dispatcher best practices, and non-owned, undescribed trailer physical damage versus trailer interchange, which is critical for everyone to understand when we operate the vehicles, the trailers that we do not own. So what is risk? What is risk? It's uncertainty of the outcome, whether it's negative or positive, that comes out from a given set of circumstances. So it could be a loss or no loss, right? So it's a pure risk. We call it a pure risk when there is either loss or no loss. Or it could be speculative risk when there is a chances for a loss or gain. But it's uncertainty of the end outcome. What are we going to get at the end? And what is the risk management? Because I asked you to imagine what risk management is, right? So let's put it in the words. It's a process. The process of managing uncertainty of exposures that affect an organization's assets and financial statements using the 5 steps. So in order to manage the risk, we have to identify it. We also have to, after we identify it, we need to analyze it, and we have to control it, find financing for it, and administer. Actually, to manage and make a little corrections if we need to. So these are a little bit of a breakdown of the steps and what's included in them. So this is my identification, analysis. We go over the risk control, your financing, administration. How do I identify the risk? You know, probably the easiest way to identify the risk is going through the checklists and inspections. You do it on an everyday, right? Basis. Your drivers inspect the vehicles. You inspect and you see the problem. You see the problem, you fix the problem. That's your next step. You see the problem, then you analyze what kind of problem this is. Can my truck continue moving, or it needs to be fixed before, and then you take the risk control and you finance it, of course. Look, can you help me to shrink it down a little bit? Because, yeah, okay, cool. The checklists and inspections, the workflow charts, the flow charts. When you have a process in your everyday life, if there is a bottleneck, it stops everything, right? Does it affect your bottom line? Of course it does, right? So it's It's a negative impact on your bottom line, and this is what we use the flow charts in order to identify this issue. The financial statements, the compliance review. I can go on and on, deeper into this, but I don't think that we have enough time for this today. So I'll just present what can it be, and if you want to take a picture, maybe talk to me one-on-one, maybe invite me into the office, and we'll explain in details. Analysis. When we talk about analyzing the risk, we're talking about the severity, how heavy the impact was. What's the dollar amount? It's a dollar amount. The frequency, how often that happens. There are some risks that we simply cannot avoid, right? If you're in a business, you're engaging yourself into risk, and you put yourself voluntarily, you're exposing yourself to risk. And we need to know, to make wise decisions, we need to know whether the risk can be expected and planned and mitigated so it costs us less, or we would have to put a block on it and say, no, we're not going to do this. It's too costly for us. We're not going to do this because it's hurting the bottom line very badly. And the cost of risk. This is the cost of risk analysis when we decide whether it makes sense to do and engage in certain activity or not. The risk control. This is when we try to mitigate the risk and reduce the impact if this is a negative impact, or reduce or increase the outcome. When we're talking about the financing the risk, whether to put money in a savings account or invest it in some more the accounts that have a high yield and make more money for company. So what are the risk control steps or methods that we can use? It's avoidance, right? What is avoidance? Anyone tell me what avoidance is? Okay, so when you inside your operations, when you decide, should I start transporting a hazmat? And you say, well, it's too risky. I don't think that I'm ready to invest so much of my time and effort and everything. So I'm going to just not do this. And this is avoidance. You avoid engaging into risk. The prevention would be something that you ready to engage, but you can limit yourself to a certain point. That's preventing the risk. And then we have a reduction of risk when we try to reduce the impact and negativity of the risk. Then we can disaggregate. Imagine you have a warehouse, right? And you, instead of keeping a stock of product for your clients, that is like $2 million, right? The chance for a fire or some other disaster bringing down the whole product, the whole piece of the product, it's big. So what we try to do is segregate it and to put it into two different warehouses, or maybe create a faster turnout for the product so it leaves your warehouse and not stays there for a long time. Same thing with the parking lots. If you have a parking lot with 50 vehicles parking overnight, the risk is greater comparing to having 2 or 3 parking lots that are smaller in size, but they hold a lesser number of vehicles. You understand what I'm talking about? Just nod your head if you're with me. Okay, cool. And then there is a transfer. Of course, we do have risk sometimes, but we want to shift this risk and say, no, I'm not going to be responsible for this, or I'm going to make someone else responsible for this. But when we talk about transferring the risk, we also need to understand who our partners are. Myself and my neighbor Johnny, we can engage and put some contract together, but I know Johnny doesn't have work, he doesn't have money, but he promises in the contract that he'll protect me, he'll do something for me, and I'll do something for him. Who we engage with and how are we going to make them accountable? Will they respond back? And will they live up to their responsibilities to me? This is, as a business owner, as a business partner in your organization, you have to decide who you deal with and whether they are solvent enough to maintain their promises and keep them and live up to them. Then there's financing. Look at the financing. I like the concept, and I would like you to take a little bit different approach into risk and all the possibility of losing stuff. There is no such a thing. I'm pushing this concept to you and see if you like it. There is no such a thing as uninsured risk. It is 100% insured always. It is insured by either your bank account, or your line of credit, or your cash flow, or your anything. It's your own money that you risk with and you put up. So there is no such thing as uninsured. It's always insured. Now, we need help sometimes because the amount that we need a little bit greater than what we have. So we want to bring another party into helping us paying for this, right? Okay, so if we cannot avoid the risk, we need a partner to help finance it. And how do we? Now, this is when we ask for insurance policy. There are some retention. When business pays for their own expenses, it's called retention. And we can either plan the retention because we cannot avoid it. We know that we're going to have it, and we know that historically we had these losses for years, and we know that we're going to spend $120,000 in losses, and there was 17 instances, right? We plan and we know we can set up a bank account or find another way to finance it without engaging our insurance policy into the place, right? And pay them higher premiums because of our losses. So we can maybe buy a policy with higher deductibles and save the money there and put it on the side, ready to pay for the losses because we know we're going to have them. So there's a planned and also unplanned expenses, unplanned retention. This is something that we entrust to insurance underwriters to say, okay, what is going to cost to have my unplanned expenses covered? Funding, internal, external. I think we all understand what internal sources are, right? It's your bank account, it's your line of credit, it's the sale of assets that you have when you need money. And liquidity of your assets is going to be a big part of it, how fast you can get a certain number of dollars. And if we cannot handle the amount with our own finances, we need to go and ask for a bank loan to get a bond or something like this. Insurance, another way to finance it, and it's probably the cheapest way to finance it. Insurance historically had shown that this is a cheapest way to finance your losses. Transfer, control and responsibility indemnification. There are two different ways of how you can transfer the risk. Sometimes you just make someone else responsible by signing a contract with them. And what is this contract going to do? Are they going to be paying on front end, or are you going to be paying on the front end, and they will be indemnifying you? And if they will indemnify you, how are they going to do this? Do they have enough money? And administration. Okay, the review of results, how well our insurance program, our risk management program works. We need to monitor and make some adjustments and work on the new projects. All right, so this is it for risk management basics. I invite everyone to think about this a little bit more and maybe employ in your organization. Okay, so if you need help, please give us a call. We'll gladly to show you around how it's going to work for you. A few things about the brokers, right? The brokers practice the best practices. At some point, you would have to decide on procedures and on acceptability for your carriers, what you can do, what you cannot do, and establish the criteria for motor carriers, who you're going to deal with and who you cannot. You're not ready because they do not qualify. So you need to establish the approval parameters for motor carriers and their leased owner operators. And you also want to include the length in business under same DOT and MC number, number of vehicles in the fleet. There are several factors to it. They're all displayed on the screen. So I'll just read them. Are there any seasonal breaks that would create a bottleneck for your operation to satisfy the shipper's needs? driver turnover, vehicle turnover. What if motor carrier is unable to maintain the same number of drivers and the drivers are only changing? What does this motor carrier do? What they do wrong that owner operators do not stay with them? So do they provide enough training that owner operators each and every new owner operator comes to the fleet? Are they trained well? Are they going to satisfy your shipper's needs? These are big questions that we need to ask. So the driver turnover and vehicle turnover is a big factor. SMS scores, very good indicator of where the trucking company goes. The driver's dispatcher's familiarity with commodities and to be transported, driver's experience and age of the vehicles, and verify insurance coverage, of course. Another item on my list is to define the type of operations and decide what you're going to do, the area that you're going to operate, a requirement for the equipment that you need available to satisfy the shipper's needs. Okay, so these are the steps to creating a better practices for freight brokers. You need to create a protocol to verify equipment and driver readiness, follow the protocol, and exclude unapproved exceptions. If one person in your office, the freight broker agent, decides and he or she is the ultimate decision maker, this person needs to be very accountable and disciplined as far as not going outside of your target operations. Follow the protocol, exclude unapproved exceptions, and if it's possible, assign the responsible supervisor with override rights and backup. Establish the document management system for faster turnaround of the documents with drivers, so they can just upload the documents and you get a hold of them very quickly. There is also accountability for reporting to make sure that the procedures and protocols that you set, they are followed, and there are consequences for not following them. What would be your practice? Retrain, terminate, whatever. You have to decide on this. But someone needs to ask these questions in your operations. There are a few items that I put together if you already have a checkup list that for dispatchers to check with drivers whether the driver is ready to go and pick up. Okay, the checklist on here, I can send the checklist. If you're interested, just provide me with your email information. I'll send it out. Yeah, because I need to wrap up. Okay, very briefly, touch base. This is critical. I know I only have a few minutes, so I'm going to be moving very quickly. I'll let you read that stuff. I'm sorry. Okay. There are multiple instances of trailers, undescribed trailers, not being properly insured because of the different requirements and different type of operations. People think that the undescribed trailer is something that simply does not have the VIN number on the policy, insurance policy, and this is wrong. This is not so. The undescribed trailers must not be owned by the insured. Okay, they are the coverage for undescribed trailer physical damage only applies when the power unit and trailer is connected at the time of accident. There is no regard for insurance contracts. So insurance company or agent, they have no idea what contracts we sign, right? So do you always tell them, I signed a new contract with a new broker for every load? Probably not. So chances are they don't know what your operations are frequently, and you want to, you need to understand that they're not responsible for every signature that you place there in your operations. Container is not a part of a trailer. Okay, this is, I don't know how many times I need to tell, there are intermodal equipment. The definition of intermodal equipment is something that has a combination of the combination of chassis and a container box itself. Sometimes the box, the majority of claim adjusters, they would not recognize the container, the box itself, as a part of a trailer, and putting intermodal equipment and trying to insure it under undescribed trailer or non-owned trailer physical damage policy is wrong. It's not proper way of insuring it because the container box is not a part of a trailer, only chassis.